Banks don't make money because they're smarter than you. They make money because most people don't understand how banks work. And once you see the system clearly, you start using banks very differently. This video isn't anti-bank. Banks are useful tools. But like any tool, if you don't understand how it works, you usually pay more than you need to. Let's break it down, simply. At the most basic level, banks do one thing. They borrow money cheaply. And they lend that same money out at a higher price. When you deposit money into a bank, you are lending money to the bank. In return, they pay you interest, usually very little. Then the bank turns around and lends that money to someone else at a much higher interest rate. The difference between what they pay you and what they charge borrowers is called the spread. That spread is the foundation of bank profits. Many people wonder why their savings account pays almost nothing. The answer is simple: your money is extremely cheap for banks. Most customers value convenience and safety more than yield. So banks don't need to compete aggressively on interest rates. If inflation is running at 3 or 4% and your savings earns less than 1%, the bank is effectively borrowing your money at a negative real rate. From their perspective, that's an excellent deal. Credit cards are one of the most profitable products banks offer. Here's why. If you pay your balance in full every month, the bank earns interchange fees from merchants. If you carry a balance, the bank earns interest, often at very high rates. If you miss a payment, the bank earns fees and penalty interest. In every scenario, the system is designed to monetize predictability. Not mistakes, predictable behavior. Overdraft fees, late fees, minimum balance fees. These are not edge cases. They are engineered revenue streams. Banks study customer behavior closely and design fee structures around common habits. Small missteps, repeated millions of times, generate billions in revenue. Contrary to popular belief, banks don't need customers to be wealthy. They need customers to be stable. Predictable income, predictable spending. Predictable borrowing, stability makes risk easy to price. And priced risk is profitable risk. Once you understand this, your behavior naturally shifts. You stop paying interest unnecessarily. You automate payments. You avoid fee-based products. You treat credit as a tool, not an extension of income. Banks are still useful. You just stop being the easy side of the transaction. Banks aren't villains. They're businesses with incentives. And when you understand those incentives, you stop leaking money quietly. That's when banks start working for you instead of the other way around.